When most traders think about risk, they focus on the obvious: price going up, price going down. But professional market makers see risk on an entirely different level. That's where gamma hedging comes in, the hidden technique that allows hedge funds and banks to control risk in ways most retail traders have never even considered. Welcome to Derivatives Trading Mentorship. Here we don't just talk about trading, we bring you the advanced professional data and proprietary hedging levels used by institutions around the world. And if you want direct access to our gamma and delta hedging calculations, visit us at www.derivativestrading.com. What is gamma? To understand gamma hedging, you first need to understand what gamma really means. You might already know delta, the sensitivity of an option's price to changes in the underlying. For example, if an option has a delta of 0.5, a $1 move in the underlying stock adds about 50 cents to the option's value. But here's the problem: delta is not fixed. As the market moves, delta shifts. And the rate at which delta changes is called gamma. Think of it like this: delta measures speed, gamma measures acceleration. If you're trading without understanding gamma, it's like driving a race car and only looking at your speedometer while ignoring the fact that your acceleration could throw you into the wall at any second. Why market makers care about gamma? For a hedge fund or bank making markets, gamma exposure is everything. When clients buy options, market makers take the opposite side. This leaves them with massive delta risk. To neutralize it, they hedge. But because delta changes as the market moves, the hedge is never static. That's where gamma hedging comes in. By tracking gamma, institutions know how often they'll need to rebalance their hedge, and how violent those rebalancing flows could be. High gamma exposure means deltas are moving rapidly, requiring constant adjustments. This can fuel volatility in the market. Low gamma exposure means deltas are relatively stable and hedging flows are lighter. Market makers study gamma levels daily because it's the invisible force driving intraday moves. And with our proprietary data at Derivatives Trading Mentorship, we calculate these gamma levels so you can see what the institutions are watching. How gamma hedging actually works. Let's say you're short calls as a market maker. When the underlying price rises, your delta risk increases against you. To stay hedged, you buy the underlying stock or futures. But as gamma kicks in, your delta exposure accelerates. So, you're forced to buy more and more of the underlying as the market rises. This creates a feedback loop, fueling rallies. The opposite happens on the way down. You're forced to sell into declines. This is why gamma is so critical. It doesn't just impact a single position, it influences market behavior itself. Entire rallies and sell-offs can be traced back to gamma hedging flows. The hidden advantage. Here's what separates professionals from retail traders. Retail traders often think the market is random. But hedge funds know when gamma is high or low. They can anticipate where volatility will spike, where momentum might stall, and where hedging flows will create artificial demand or supply. By hedging gamma exposure, they're not just protecting themselves, they're positioning themselves to take advantage of the very moves their hedging flows help create. That's why understanding gamma isn't optional if you want to think like an institution. How you can use this knowledge. You don't need to be running billions in capital to apply gamma awareness. Recognize that price moves are often driven by hedging flows, not just supply and demand. Pay attention to gamma levels to anticipate volatility. When high gamma around certain strike prices causes the market to gravitate toward them. At Derivatives Trading Mentorship, we make this practical by giving you daily gamma hedging levels, the same type of insights market makers and hedge funds are using. To learn more, visit www.derivativestrading.com. The takeaway. Gamma hedging is one of those concepts that separates retail trading from professional market making. It explains why markets sometimes explode with volatility and why other times they feel glued to a level. Hedge funds don't guess, they calculate. And by mastering gamma, you can stop trading blind and start understanding the hidden forces shaping the market. If you found this video valuable, make sure to subscribe to Derivatives Trading Mentorship for more deep dives into the strategies hedge funds actually use. And remember, if you want direct access to our proprietary delta and gamma hedging data, you'll find it at www.derivativestrading.com. Thanks for watching. Trade smart, manage risk like a professional, and never underestimate the hidden power of gamma.